Welcome to Delphos Insights. This is episode 35, where we examine why freight costs now determine agricultural financing terms in Latin America.
Right, and it is a massive shift.
Yeah, well, for today's deep dive, we are looking at a stack of recent trade reports and logistics data. And the big takeaway is honestly pretty striking.
It really is.
Basically, your shipping route is now dictating your interest rate. We're going to explore how things like freight volatility, trade routes, and buyer diversification have transformed from just operational footnotes into, well, the central credit variables for agribusiness financing.
Yeah, the numbers behind this structural shift really tell the story. I mean, Latin American goods export value actually grew 6.4% in 2025.
Wow.
Right. And South American outbound volumes surged 6.9%. But the critical detail is where those goods are going. We are seeing a really decisive pivot away from the U.S. and heavily toward Asian markets.
Oh, interesting.
Yeah, in fact, Brazil's agribusiness exports to the U.S. declined 5.6% recently.
Okay, so that shift naturally means, much longer routes for these agricultural goods.
Exactly. And with longer supply chains comes this massive increase in transport cost exposure.
Right, that makes sense.
Because these new Asian routes are so extended, any vulnerabilities in the middle become, well, existential threats, not just delays. Take the Panama Canal, for example.
Oh,
Right. When the severe drought hit, daily transits dropped to just 18 vessels per day. That is a 21% drop.
that is wild.
It is. And I mean, transit volumes did recover later in the fiscal year to 489,156 net tons, which was up 15.6%. But that disruption exposed a glaring risk for anyone moving agricultural commodities.
Right. It is basically like having a massive factory with only one highway out. If there's one roadblock, your entire financial model just collapses.
That is exactly how institutional lenders view the risk today. And it is not just the outbound journey either. Look at Brazil.
What is happening there?
Well, they rely on imports for 80 to 90% of their fertilizer. So the logistics risk sits on both the input and output sides simultaneously.
Oh, wow. So it compounds.
Totally. Throw in domestic port congestion like the Port of Santos, nearing its maximum capacity of 179.8 million tons, and those shipment delays immediately start eating into cash flow. I mean, that congestion cost coffee exporters $1.57 million in a single month.
Wait, let me push back on that a bit. If I am an agribusiness and I am pulling in the exact same revenue as my competitor, are you saying banks will genuinely penalize me with tighter financing terms just because I sell to one major buyer instead of diversifying?
It absolutely will.
Really? Just for using one port or having one buyer?
Yeah, export concentration directly dictates your terms now. Lenders are rigorously scrutinizing logistics resilience during due diligence. They want to see, demonstrated alternative routing, built-in shipping cost buffers, and a diversified offtake structure.
That is a huge shift in how they evaluate risk.
It really is. If you present a financial model to an investment committee today without base cases, stress scenarios, and modeled corridor alternatives, it simply will not pass their filters.
So how do you actually secure funding when the filters are that strict, especially considering the global trade finance gap reached $2.5 trillion in 2025?
It is tough. Traditional commercial debt clearly is not keeping up with the demand.
Right.
But this is where development finance institutions, or DFIs, step in to bridge the gap. They utilize structures that mobilize commercial capital that would otherwise just, sit on the sidelines, Right.
like
A/B loans.
Okay, let us unpack that mechanism. How exactly does an A/B loan structure help an agribusiness borrower in this environment?
It essentially lets commercial banks piggyback on a DFI's special status. In a preferred creditor framework, the DFI is legally first in line to get paid back.
Okay, I see.
Because commercial lenders feel safer operating under that DFI umbrella, they are willing to participate and offer longer repayment periods, which are known as longer tenors.
Ah, that makes sense. So if I'm understanding this right, you still have to apply these instruments carefully. Like trying to use one giant credit line to cover the farm, the warehouse, and the ship is a massive red flag for underwriters.
Oh, completely. It creates a structural mismatch they will immediately reject. Financial instruments must map precisely to the operational stage.
So working capital covers production, obviously.
Yes. And then inventory and warehouse receipt finance covers processing and storage. Think about how DP World handles 60% of Peru's avocado exports.
But you're valued at like $438 million, right?
Exactly. Tracing that product clearly strengthens the collateral at that specific stage. And finally, export credit is utilized specifically to bridge the 60 to 120-day buyer payment gaps while goods are on the water.
It requires an incredibly rigorous approach to institutional debt. As you assess your capital stack, does your financial model demonstrate the routing flexibility, buyer diversification, and governance quality required to survive an investment committee stress test today?
Ultimately, if you are building that massive factory, you cannot afford to plan just one highway out. You have to map the detours long before the roadblock ever appears.
This has been Delphos Insights. Learn more at delphos.co.